Is the 4% rule still something that we should be following when it comes to retirement? Now, by the way, if you have a question for us, there's a link right below the video. You can click and type in your question, and who knows, maybe we'll cover your question on a future episode. Well, first, what is the 4% rule? October of 1998, my parents came to me and said, hey, Mike, we're looking to retire here at the end of the year and we want your help. Back then, it was 1998, we knew how to plan for retirement. We used the 4% rule. So what is the 4% rule? Well, here we have an Investopedia definition of the 4% rule. You can go ahead and go to Investopedia and read out all about it, but I'll tell you in English what it was. It's really simple. Research told us that if you would build a balanced portfolio, roughly half of your money in stocks and roughly half of your money in bonds. But as long as it was diversified, some US positions and international positions, maybe sprinkle in some real estate, if you do a good job having a diversified balanced portfolio, then you should be able to withdraw 4% of your initial amount and then each year increase that with inflation. For example, if you retired with $500,000, right? The first year you could take out 4%, which would be $20,000, and then that $20,000 each year could grow with inflation. And the research said that if you followed that rule, that your money should last about, 90% of the time for a 30-year retirement. That was kind of a path that we followed, and that's exactly what I did for my parents. January 1, 1999, in the first year, the market was good, and it was awesome. My parents, by the way, when they retired, had $300,000. They wanted to get 4% of that, which was $12,000 a year or $1,000 a month. And so the first year, that's what we did. I invested in a balanced portfolio. They took their $12,000, and at the end of the year, they had $320,000, meaning not only did they take their income, but they grew their money. It was awesome. In 2000, dot-com crash. 2001, 9/11. 2002, recession. By 2000 through 2002, in that 3-year period, the stock market, like big blue chip companies, were down 43%. 43%. Now think about this. Here are my parents and the rest of our clients in a balanced, diversified portfolio. They're taking out 4% every year for 3 years in a row. That's 12%. Then their portfolio, the stock portion is down roughly half. And if there's another 25%. And the bonds were doing well. At the end of the day, at the end of 2002, my parents, they started with $300,000. Taking out 4%. We set it up exactly right, following this 4% rule. They were down to about $160,000. Almost half of their money was gone. And guess what? So was everybody else who was retired at the time. If my parents would have kept taking $12,000 a year out of that portfolio, and at the time is $160,000, they would be broke today. They would have gone broke just like that. In 2008, the stock market's down 37%. The year and a half period from October of 07 to March of 09, that year and a half period, big blue chip company stocks down 50%. Again, if you were following the rule of the 4% rule, balanced diversified portfolio, taking out 4%, again, you would have failed. You would have gone broke. What we have learned is that this 4% rule, we've learned that it only works when the markets cooperate. Markets go south, you're in trouble. And in fact, Morningstar now tells us that rule is dead. Morningstar says the 4% rule, dead. Morningstar's research says that if you do a balanced portfolio in today's world, interest rates are a lot lower, markets are volatile. In today's world, that 4% should only be 2.8%. As some people in the South might say, that dog don't hunt. Right? You don't want to, that's just not enough. If you structure your portfolio the right way, you can enjoy 4% income, maybe as much as 5% income on your portfolio in retirement, and do it with a lot of safety. I've got this article right here to my right. The title right here, this article, Planning for Retirement Income in an Increasingly Volatile and Uncertain World. And it actually says in this article, if you follow that 4% rule, if the stock market is down 20% for the year, just one time, in the first 10 years of your retirement, that thing's going to completely collapse on you and you're going to run out of money. The historical way of doing it, balanced portfolio, diversified, withdraw 4%, that just doesn't work anymore. But you can get 4%, you can get 5%, maybe even a little more if you have the right strategy. That, by the way, would be a topic of another video. But there you go, that answers the question. Is the 4% rule still legitimate? Not so much the traditional way, but do it the right way and it'll probably work for you. We'll see you next time.